All right, in this explainer, we're going to decode some of the market's secret language. We're going to zoom in on three really powerful single candle patterns that can scream, hey, a major reversal might be coming.
So, here's the big question. Can a single day's worth of trading really predict a market reversal? I know, it sounds a little like reading tea leaves, but the answer is a surprisingly confident yes, but only if you know how to read the clues the market leaves behind.
So here's our game plan for today. We're going to start with this foundational shape called the paper umbrella. Then we'll see how that one shape can morph into either a bullish hammer or a bearish hanging man. After that, we'll meet its cool inverted cousin, the shooting star. And then we'll get to the most important part. How do you actually trade these things? Okay, first things first, we have to get our heads around this core shape, this one candle that's the building block for two of our key patterns. Think of it as our Rosetta Stone for spotting reversals.
This shape is called a paper umbrella, and it's pretty simple. It's got a small body up top and a really long lower shadow. But here's the twist, and this is what makes it so powerful. Its meaning completely flips depending on the market trend leading up to it. So yeah, the exact same shape can signal both good news and bad news. Now, for a candle to officially qualify as a paper umbrella, it has to pass one very specific, totally non-negotiable test. It's just a simple math rule, but it's super important.
And here it is, the golden rule. That lower shadow has to be at least twice as long as the real body. That ratio is everything. Why? Because it's the visual proof of a massive tug of war that happened between buyers and sellers that day. Okay, let's see this shape out in the wild. Because when it shows up in a very specific situation, the paper umbrella gets a brand new name and sends a really powerful bullish message. And here's the key. When you spot that paper umbrella shape after a clear downtrend, after prices have been falling, it's not just a paper umbrella anymore. It gets a promotion. We call it a hammer. Its location at the bottom of a slump is what gives it its name and its bullish power. You know, every candle tells a story, and the hammer story is a thriller. It starts with the bears still in charge, pushing prices down to a new low. But then, bam! Right at that low point, the buyers, the bulls, they just storm in. They buy so aggressively that they drive the price all the way back up to close near where it started. That long lower shadow, that's the footprint. That's the evidence of the bulls making a stand and winning the battle for the day.
Now, let's do a little experiment. Let's take that exact same shape, the small body, the long lower shadow, and drop it into a completely different neighborhood on the chart. You're about to see how it sends a totally opposite signal.
And here it is, the big aha moment. The hammer and the hanging man are physically identical. You can't tell them apart just by looking at the candle itself. The only thing that separates them is the trend that came before. A hammer shows up after a downtrend and signals a potential bottom. A hanging man pops up after an uptrend and warns of a potential top. It's all about the context. Context is everything.
Now, this is really interesting. The source material gives us a little nugget of wisdom from experience. The author basically says, look, if I had to bet, I'd put my money on the hammer being a more reliable signal. They kind of question the logic of the hanging man, like, if the bears were really taking over, why did the price bounce back so much during the day? It's just a great reminder to always think critically about the psychology behind these patterns.
All right, time for one more pattern. This one is easy to spot because it basically looks like an upside-down paper umbrella, and it carries a pretty clear bearish warning. So meet the shooting star. It's got that small real body, but this time it's at the bottom. It has almost no lower shadow and a long upper shadow. And just like our other patterns, that long upper shadow has to be at least twice the length of the body. You'll find this one after an uptrend, and it's a sign that the trend might be reversing to the downside.
The story of a shooting star is a story of brutal rejection. The market's been climbing, the bulls are feeling good, and they push the price to a brand new high. But right at that peak, the sellers come out of nowhere with overwhelming force. They just slam the price all the way back down. That long upper shadow, that's a battlefield map. It shows exactly where the bull's attack was stopped dead in its tracks.
Okay, so spotting these patterns is the first step. It's fun, it's like being a detective. But actually acting on them, well, that's what really matters. So how do you go from spotting a clue to actually building a trade?
So there are generally two main ways to go about it. You've got the risk taker who jumps into the trade on the same day the pattern forms, trying to get in at the earliest possible moment. Then you have the more risk-averse trader. They prefer to wait a day for more proof, for confirmation, like seeing a strong green candle the day after a hammer, before they'll commit their capital.
Let's make this crystal clear with a real example. So here we see a hammer on a chart for Cipla. Our risk taker? They buy on the same day the hammer forms, right around 444. The risk-averse trader waits for the next day's bullish candle and gets in at 445.40. But, and this is so important, look where they both put their stop loss, 441.50, the absolute low of the hammer. That part is the same for both.
And that brings us to what is probably the most important rule of all. Your stop loss is your non-negotiable safety net. For a bullish trade off a hammer, your stop goes at the low of that hammer candle. For a bearish trade on a hanging man or a shooting star, your stop goes at the high of the candle. This way, you know exactly how much you're risking before you even click the buy or sell button.
And please remember this, not every pattern is going to lead to a winning trade. That's just a fact. But when you use a stop loss, a trade that goes against you isn't some random failure. It's actually the successful execution of your risk management plan. You took a small, calculated risk and it didn't work out. You live to trade another day. That's just part of the game.
Okay, let's do a quick lightning round recap. Number 1, context is king. The prior trend is what tells you if you're looking at a hammer or a hanging man. 2, the 2-buy rule for the shadow to body ratio is the price of admission. No exceptions. 3, know your style. Decide if you're a risk taker or risk averse and plan your entry. And finally, the big one, always, always, always use a stop loss.
So there you have it. We've gone over the shapes, we've talked about the psychology behind them, and we've laid out a trading strategy. You now have the tools to spot these potential turning points in any market. The only question left is, where are you going to spot them first?